And I'll just quickly go through this. This presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by forex.com. This presentation has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information and commentary provided. Futures, options on futures, foreign exchange, and other leveraged products that involve substantial risk of loss and are not suitable for all investors. Spot gold and silver are not subject to regulation under the U.S. Commodities Exchange Act, and contracts for difference, or CFDs, are not available for U.S. residents. Okay, everyone, let's get started. I want to start with by looking, or just a general overview, really, of what the markets are doing. I know some of you will be trading at the moment, and I know some of you will find it quite frustrating how the markets have reacted. Sorry about that. How the markets have reacted. They have been very choppy. There's been a lot of fake outs. There've been a lot of, false breaks. This is a prime example, right? This is Aussie. We're now testing above that 200-day moving average. Just bear with me one moment, because it doesn't seem like this is quite correct. Here we go. The 200-day moving average is coming in at 91.38. We're currently trading 91.44. We've had a very, very tight range so far today in the London session. Haven't really moved too much about, but I think this is, one of the prime examples. A lot of people will be looking at this level. A daily close above, say, 91.5 is going to be a very bullish development. Will it follow through tomorrow? I think that's the big problem that we've got right now. Is will it be able to, will we be able to see some follow-on? We just haven't seen that of late. Certainly, don't seem to have seen that recently anyway. And we will be watching very, very closely to see if that is the case. We certainly would like, obviously I think the markets would like to see some trends. The Aussie is one place to look because it has been leading the markets. And I'm just going to show you it has been leading in the G10. Let me just bring up another chart just to show you how well the Aussie has done. Even just from the start of this month, just really from the start of this month, the Aussie is a really top performer. It's up 2.32%. Even though, if you just look kind of back here, even though it doesn't look like it's actually gone very far, that's the type of, this is what we're working on at the moment. And this is, this is as well as it can be, as well as it can go. Now, examples whereby things have been a bit more frustrating. Euro. Yesterday, Euro was weak all day. It looked like it might close below 137.80. Why is that significant? Let me just draw it in and I'll show you. (38.2% retracement of the February to March advance, but it didn't. Instead, what it did was bounce higher, break out of its near-term range, get to a high of kind of just below 139. And then what did it do today? It turned around again. Some of you may have been trading Euro. You've been very, very frustrated. We certainly were. It wasn't a news-driven move. It looks like it was just a nasty short squeeze. And the markets have really not been doing, fantastically well. And instead, what we've seen is, are these fake outs. That's why I'm looking at the Aussie so closely, because we are now at a very significant level. Right, a 200-day moving average is not something to be sniffed at, whereas a 38.2% retracement, sometimes a lot of people don't know that, or they might not be that interested in it, etc., etc. So what we're seeing here is, certainly something of a, very frustrating market. My advice to you is when we're kind of driven not necessarily by sentiment, like we were, for example, yesterday, that moved higher in the euro, it wasn't because of some big data that came out that was euro positive. It was because of pure positioning. It wasn't sentiment driven, and they're difficult markets to trade. I mean, Pan, you've just said everyone at ACB has been saying strong euro is bad for the economy. Indeed, they have. In fact, the latest person to say that was Jens Weidmann. He actually came out and touted negative interest rates. He even said QE wasn't ruled out. And that seems to all be on the back of the weak euro, because we've started to see the German data come off the boil. And obviously from a German perspective, if you're a massive exporter, you don't want necessarily a strong euro. So that's been a bit problematic. And we've seen certainly some pockets of weakness in the euro, but nothing in any way to kind of, at the moment it's not directional, it's not clear cut enough. The market isn't reacting to those statements the way that one would expect. There's a couple of reasons for that. Number one, the market tends to, I always think the FX market tends to be limited to one thing. It tends to hone down on one theme, and right now that theme is very much, what is the Fed going to do next? We obviously had Yellen last week. She surprised the market. She was deemed quite dovish. Quite more hawkish, considering she's such a dove. But yet what we saw was no follow through. So let me just bring up the dollar index chart because, and Pranoy, this is all important to you as well. I know you're looking at your cable position. This is just dollar index, which has been a key driver of cable actually. The cable fell off as we saw the dollar really rally, get back above that 80 level, on the back of Yellen's comments, which were perceived as hawkish. Then the market's just lost faith. We need to see way more than Yellen. There is a risk that some other Fed members, will come out and be extremely dovish. And if anything, the market, the Fed Governing Council is still very much kind of tilted towards the dovish stance, even though obviously Yellen had to represent all views. It is one man or one woman, one vote on the Fed. And there are more kind of cautious people, I would say, rather than the apostles and the officials who are kind of going out, all guns blazing about how they need to cut rates, etc. We just couldn't get above this 50-day moving average, which is a very bearish sign in my view. It doesn't suggest that the market is on the side of the dollar, and that is what's limiting the euro's decline. It's also limiting cable's decline, even though cable has come under a bit more pressure, I'll argue. But it's this comes into play as well. These are 10-year Treasury yields. I know those of you who join me a lot will know I like looking at yields. I think they're a key driver, and I think they're one of the main reasons why the dollar hasn't been able to rally, and we haven't been able to see any trends or themes really take over in the market, because largely Treasury yields are still very much stuck in their range of the last 2 months, basically going back to the beginning of February when they made that low of sub 260. Since then, we've been to a high of just above 2.8, but we couldn't even do that on Yellen and the Fed turning around and saying, well, actually, you know what, we want to see, maybe interest rates will rise in 6 months after we end QE. So maybe that will be actually March. Whereas the market had actually, been pricing in for an autumn hike in 2015. Autumn to March, that's quite a big shift higher, or shift closer. And the markets didn't really react. So that just suggests to me that maybe the markets massively overreacted to Yellen, and the markets are always giving the US the benefit of the doubt on the dovish side. So that's certainly something, to watch out for. So that is certainly something to watch out for there. As you can see here, 269 seems to be cushioning the downside, and actually the 50-day at 272 is right now halting any slide. So that 280 level, we've really got to clear the 283 level before we think that could push the dollar higher. But as I said, until we break out this range in Treasury yields, it's going to be very hard for the dollar index. And because obviously, the dollar really is the hinge, right? It's so central to the whole of the FX market that if Treasury yields are a key component of where the dollar moves to next. If these can't rally, then I'm sorry, but it seems very unlikely other things will. Now, one thing I do want to just do now, I'm just going to create a chart of euro dollar and its yield spread, because obviously of those comments coming from Jens Weidmann, one would expect the yield to fall, and indeed it has. This is an interesting chart, I think. It's not perfect, but if we just go back 5 years, as you can see, for long periods of time, the euro and yield spread, so that's the spread between German and US 10-year government bond yields, they tend to move in the same direction. I'm not saying perfect, there have been times of divergence. We seem to be in one of those divergences now. Basically, for most of 2009, 2010, 2011, even half of 2012, parts of 2012, I should say, we tended to see them both moving together. with actually kind of the currency actually leading the yield spread almost. Well, now we seem to be, we then had another situation whereby we were joined together, we moved together from most of certainly the first half of last year, and since then we've just really diverged. As you can see here, we made a high in the yield spread that corresponded with the low in the euro. We're making highs in the euro corresponding with lows in the yield spread. So it does suggest that the markets are just ignoring these yields at the moment. And that doesn't mean that, yields are not worth taking into account. I think they very much are. I think the bond market and the FX market are thinking about different things. And that's really a bit of a problem. The reason why is because in our view, if the ECB does, remember they meet next week, and if we've got the German central bank sounding quite dovish, then maybe there'll be some sort of action. I think the market won't be expecting it, and that could really lead to a topple in the euro, a major topple in the euro. Now, we've been writing lots and lots about the FX market, about the euro. In fact, I'm just waiting to put my latest piece up on the website. But do check out our website on forex.com. Check out our research there. It's all up there for you. And then you can see some more. Pan, you ask a really interesting question. Your favourite question. Will Chinese economic data not limit the upside? Okay, so that's what we've been led to believe. That's what we've been born to believe. In the same way that we've been born to believe that yield spreads will last and yield spreads will determine currency direction. It doesn't always happen. And at the moment, as you can see, there's been very weak data really from January, February, March coming out of China. That hasn't really done too much to hurt the Aussie. It seems to be moving to the beat of the same drum. Do I think we're going to get back to kind of parity with China being so weak? No, I don't. Do I think it's a bit bit stupid sometimes, that investors ignoring Chinese data? Australia is not a huge economy. Australia is, if it has to rely on domestic demand, it will become less of an important economy. It's an important economy because it's an exporter. And because it exports to China and its geographical position very close to Asia, if it's trying to rebalance away from that, because that demand is slowing down because China's economy is quite weak, and that's a concern. I think at the moment a lot of people are saying, well, yes, okay, fine, China's economic data has been bad, but it's still, even with that weak PMI print, manufacturing PMI pan on Monday, is still on target really to reach a 7.5% growth target. If we get below 7.5% in growth, that's when it becomes a bit of a problem. And we think that could weigh on the Aussie. Now, as you can see, if we clear the 200-day moving average, technicals are really coming into play. We're not necessarily seeing those fundamentals really driving the market. Because you could write a whole list of fundamentals as long as your arm for reason why the euro shouldn't be as high, a reason why the Aussie should potentially be thinking about weakening. And it's just not happening. So it's certainly worth kind of pointing that out there. Now, Pranoy, you've waited very, very patiently. I will talk through cable. As you can see here, I'm not 100% sure what you mean. I have a GBP sell order at 50. Is it a good decision to wait till 40? I'm not 100% sure what you mean, actually. Are you talking about selling it at 65.50 or 65.40? I mean, we're not there now, so you'd have to leave an order out. 65, 63 is the 50-day moving average. As you can see, we just look very, very uncertain at the moment in cable. That's as near enough a doji as you're going to get these days. Tiny, tiny ranges. It just suggests to me the market is just flat out, lining out. It hasn't made its next decision, and I think it's largely because, we even today, for example, this is today. Let me just bring up today's chart. This is very unusual. We've got a range between 164.80 on the downside, 165.13 on the upside, and yet we had critical data out of the UK today. The volume's just not there. Today, that would be my argument. It's really not. We're not seeing a fantastic amount of volume at play. We're seeing very, very quiet markets to start with, which is very frustrating, and the market isn't reacting to the data. If anything, the UK data was quite mixed, so that possibly explains the muted reaction. But it was CPI, and CPI is pretty damn important for the Bank of England. So we're a little bit shocked on that. And actually, Pranoy, as much as I can see the argument for why one would move that out of the way, why one would want to place short on cable. I think it's quite neutral, and we'd be flat on cable at the moment. Largely the reason why is that we seem to be finding a good deal of support ahead of 164.70. Let me just pull up this chart. Which is a 61.8% retracement of the February to the February advance, basically, from when we were kind of sub 162.50 till we got that high above 168. So 61.70 seems to be capping the downside for now. Obviously, a break below the 61.8% fib retracement is quite a negative development, which could open the way to further lows, and certainly open the way to those lows from February, which come in at 162.52. So that is certainly something to watch out for. And if we get a daily close below 64.70, that could trigger a lot of bearish, a lot of selling, we think. It's tested that support, but it's held. And that's kind of, what we're interested in at the moment. But in our view, a close below would be very, very bearish development. Just looking at it on this chart as well. As you can see as well, we're below our zero line on the MACD. That tends to suggest bearish momentum, which is quite negative too. If we get below there, as I said, it opens the way to these lows from early February. On the upside, though, we have got the 50-day moving average, which comes in around 165.60. That should cap the upside at the moment. But as I said, as much as it's tempting to think, this looks like it's going to fall down, this looks like it could be, who's going to buy the pound anymore? We're actually trading in a range. Yes, we're weak within that range, but I think at the moment, if you hadn't got into it at 67, I think it's still very difficult to trade at the moment and to try and get in now. I think the gains just aren't there. We may have to wait till next week till we get more interesting data. When we get kind of the ECB Bank of England meeting, we also get those non-farm payrolls. The market is really desperate for answers, but in this environment, it's not really getting any because everyone, you can have so many different things. Pranay, I'm not really understanding what you mean. You're selling GBP at 500. Is a good decision to wait till 400. Are you saying you're selling it at 65 or waiting for 64? As I said, a daily close below 164.70 is a bearish development. So there could be some selling interest around about 164.50 to 60. That would be my view on there. But again, it's not a recommendation by any means. Dollar yen as well, always worth watching in this environment. Obviously, it had its big move last week on the back of Yellen being slightly more hawkish, saw kind of a big move higher, but we didn't break any new ranges. And actually, I thought the reaction in dollar yen was quite muted. And indeed, again, we're seeing very similar price action across a range of these major sterling crosses. And that is kind of worrying in itself as well. Obviously, the 50 and the 100-day moving average seem to be capping the upside for now. They come in between 102.52 to 56, so they're kind of converging there. If we get a break, if we get the 50-day moving average is just about, looks like it could potentially cross over the 100-day moving average, that's quite a bearish development as well. More of a bearish development if the 50-day crosses over the 200-day, but certainly it would suggest that momentum has just stalled. And that's what we're looking here. Momentum definitely seems to have stalled. The dollar, the market's not as positive on the dollar, and that's why we're neutral on this. Very good support comes in at 101.20. That's where the recovery came in last week, and it's the March 3rd low as well. But however, we just haven't been able to get above 102.79, which is the kind of about the 38% retracement of this down move here. If we can get back above that 102.79 level, then it may open the way back to 103.30, maybe even to these highs from March so far, which come in around 103.90-ish. That's a bullish development. But as I said, you don't get much more of a kind of tighter range than what you get at the moment. As you can see, we have been range trading for most of the last 2 months. Are we on the cusp of a breakout? I'll draw your attention to this area here. July, most of July, August, September, and October actually. That was 4 months, so we're only 2 months in at the moment. When before we even attempted to push higher, so that's kind of the key thing there. Dollar Swissy is also worth watching. Dollar Swissy yesterday, we pointed out, let me just pull up the chart. We put out yesterday that, potentially we could be capped at this 89.13 level, but we didn't even get near to it. Yesterday there was a big reversal. We got stocked out, fell back below the 88 level, and for the time being anyway, we're still getting a pattern of, of lower highs and lows. So the bearish, the bearish situation continues. It looked like a bit of a breakout, but we haven't been able to extend on the upside. So let me just annotate this. Unfortunately, it looks like maybe, it was just another fake out and we're just going to have to be patient again. We just haven't been able to extend up here. Obviously, a daily close below 87.87 or 87.85 is a bearish development, which could then take us back to the lows of around here from the 12th of March, which come in at 86, just literally 86.99. That was certainly the low point, I would say. The March 13 low, below there, you're looking at 2011 low at 85.86. Basically, if the dollar's going to be able to stage a rally, we think it will do so against the Swissy, but you've got to be patient, and there's just some time in it. At the moment, the market's not willing to do it, even though in a very, very short term, I suppose, those of you trading like literally every hour, there's been an encouraging bounce back. For those of you who just want something a bit meatier, you're going to have to wait because we are suffering from this lack of range, this lack of volume in the market. That's kind of the key thing here. The one thing I would argue, though, is that stocks seem to be doing a little bit better. And the FTSE, for example, today, let's just look at the daily chart, is high, maintaining its highs. We are testing that 200-day moving average, which comes in around 6,583. We're about over 1% up already today. But really, we need to clear that 200-day moving average because it's not just been FX that's been in choppy ranges. For the last few sessions anyway, we've also seen the FTSE as well. And what with stocks not really being able to move out of ranges on the back of the budget or the Yellen comments, it does suggest it might be just a bit harder to get traction one way or the other. So watch for a close. We'd probably look for a close above 6,600 here. Those highs from earlier this month coming at 6,640. You'd ideally like to get above there, but then if we do get above there, it would be really interesting to see. We could see some support start to wane. Interestingly enough, the last couple of days have seen a bit of a spike in volume. So there is some interest here, which could potentially limit the downside, but we will be watching that closely because at the moment we still look just a little bit pathetic in the FTSE, which suggests that we could just trade sideways. Now, guys, it's 11:30. I'm happy to take a question if anyone has one. If anyone has a question, I know lots of you joined today, so thank you so much for joining. The other thing I want to tell you all is that tomorrow at 11 o'clock, I'm going to be doing my FX Street presentation for the FX Street Expo. Look at FX Street. They will show you that. They will show you how to join if you're not registered already. Maybe FX Street admin could send a link here. But overall, please do join us. There's going to be lots of great speakers. I'm speaking at 11. Please do follow us on Twitter as well at Forex.com and follow our research. And do join tomorrow if you can. Thanks, everybody.